I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity mates, here we are for episode 20. We're bringing you a podcast where we discuss all things investing, try and break it down to make it easy for you guys. As always, I'm here with my equity buddy Ren. How are you going, bro?
I am very good, Bryce. I can't believe we made it to episode 20, to be honest.
I know, what a milestone.
Yeah.
It's been fun.
To the next 20, I guess?
To the next 20. Onwards and upwards.
Yeah, definitely. Yeah.
So, we're here to do a Basics 101 episode. We haven't done one for a while, so we thought it would be a good opportunity after having a few interviews over the last couple of episodes for us to get back into the basics and the reason that we kind of started this podcast. And we're going to go through a number of, jargon words or acronyms that you would often hear in the media or on balance sheets or, in investment and financial chat.
Yeah. These are the kind of terms that scare ordinary people away, like things that people who haven't studied finance don't understand and so never try to start investing. Yeah. But really, once you dig a little deeper, they're not too hard to understand.
No, nothing scary about them. So we'll break them down for you and tear them apart. So hopefully it will help you make some informed decisions with your investing. Yeah.
Well, maybe we should give a plug to some of the things that we're doing outside of the podcast.
Yeah, good idea. So we've now officially become YouTube channel.
Yeah, that's official. We can't put ads on there yet. We need 10,000 views, so get watching, everyone.
What are we at? 7?
Last time I checked, yes, 7, and I think 3 of them were me. So
yeah, so just letting everyone know, we're now on YouTube. It's just another channel for us to get our podcast out there. If you're at work or whatever, you want to throw it on in the background, it's another way you can do it. So let everyone know. And also, we've started a weekly email called the Equity Mates Thought Starters, and this is something that we're going to be sending out every Monday, and it's just a way that we're going to be giving you guys some information about what we have found interesting during the week, and it's to help you guys understand where we look for information and what sort of stuff we like to frame in our investing decisions. So do you want to give a bit of a rundown of what that includes, Ren?
Yeah, so the most common question we get here is, where do you guys find your information?
Yeah.
And that is the same question that I had when I started investing. There is so much information out there with the internet and everything these days, but it's really hard to know where to look. So what we're trying to do with Equity Mates Thought Starters is send 5 links to your inbox every Monday that just give you an idea of some of the different resources that are out there and where you can find them.
Yeah.
So for example, the first Equity Mates Thought Starters went out last Monday, and some of the things included a company's annual report, some financial news articles, and some advice from a major bank. So, that's some of the areas where you can get information. Some of the ones we've got in store this Monday.
Don't give it away.
Oh, okay. Everyone needs to sign up.
Yeah. So how do you sign up? How do you get this email?
To sign up, you can jump on our Facebook page, and there's a sign up button. It will take you to a sign up form. All you need to put in is your email address, really. You can give us your name as well if you like, but feel free to make up a fake name if you want to remain anonymous.
And you can also do it through our website, can't you?
Yes.
Yeah, I'm really excited about this. I think it's a good way for us to put out a few things that we might otherwise forget or don't have time to do through the podcast. So I see this as an evolving thing as well, some videos and all that sort of jazz. So I think it's going to be great. Sign up. It'll be good.
Yeah. Sign up, like, subscribe, rate, comment, review.
So I also, very briefly, we're going to bring back as well, we haven't done for a while, the stock of the week. We're going to bring it in a different format, so we'll discuss that later on when we get to it. But let's kick straight into what have we learnt this week, Ren?
All right. So What I was going to do this week is talk about the end of quantitative easing. Now, that's something that you guys might have heard about, you might have read about, or you might have no idea what that is. At the last minute, I've decided to change, but I'm going to include a good explainer on quantitative easing in the Equity Mates Thought Starters email. So if that's piqued your interest and you want to learn a little bit more, make sure you sign up.
Yeah, very interesting and very topical at the moment.
Yeah, very topical.
Yeah.
But the reason I changed was last night I was reading an article and I was blown away, let's say.
Oh, wow.
So the biggest bank in America, JP Chase, many people would have heard of. They have a balance sheet that is the size of 1/8 of the American economy.
What?
So they're a big bank. And as with most big American banks, they were acting fraudulently in 2008, and there was a bunch of stuff. There was a lot of fraudulent loans, and everyone knows what happened in 2008. The housing market collapsed because of the actions of these big banks, and everyone suffered the consequences. Well, in the aftermath of the 2008 housing crisis, JP Chase agreed to two separate settlements with the Department of Justice in America.
Yeah.
And it's just come out that in paying these billions of dollars in settlements, rather than paying in cash, JP Morgan has actually paid in more fraudulent loans.
What?
Yeah. I know.
What?
They are actually just taking the piss at this point.
So they're offloading just a whole heap of junk.
Well, no, it's even worse than that. So, in the aftermath of 2008, they tried to get all these terrible loans off their books. So what they did was they sold them for pennies on the dollar to other companies and other, mortgage brokers, other investors, who then work with these people to restructure their loans. And there's a whole industry in this. But that's not important for this story. What's important is JP Chase sold all of these loans, and then in their settlements with the US government, they agreed, rather than paying cash, what they would do is forgive loans to the value of the settlement. But rather than forgiving loans that were on their books, what they did was they forgave the loans that they had already sold to other investors, and then claimed to the government that they had written them off their books. And so this has been going on for years and years and years, and it's just broken recently that they've done this. And the only reason it has broken is one of the people whose mortgage they sold and then tried to write off as one of their own lived next door to the Speaker of the Maryland Parliament, which is Maryland's a state in America. And so she spoke to her neighbour, and the Parliament investigated it that way.
You're kidding.
But if that coincidence hadn't occurred, they would have got away scot-free.
What?
Yeah. So
the question in my mind is what's actually going to happen, though, because it always turns out that in these situations, the big banks just get away with anything, and they know it as well. So I'm
100%.
interested to see what happens.
Well, it's Trump's Department of Justice now, and no one expects Jeff Sessions to go after these big banks. But in saying that, Obama's Department of Justice was weak with these banks. This JP Morgan settlement in the first place, and the fact that they allowed them to get away with paying with these fraudulent loans that they had already sold and made money off. My biggest bugbear is in 2011, the largest money laundering case ever in history was brought against HSBC.
Yeah.
HSBC admitted that they had acted illegally.
Yeah.
And yet no one went to jail.
Yeah.
They paid a fine.
Yeah, a fine. It wasn't even a fine. It was a couple of dollars in change.
Yeah, for them, yeah.
For them, yeah.
Yeah, it was literally, if you and I start embezzling money or start trying to launder, a few $100s, we could go to jail. But HSBC laundered billions of dollars. And it was for, it was for the Iranian regime who was under sanctions and for drug cartels. It was serious money laundering.
Mate, Centrelink came down on me a couple of days ago for mispayment in 2015.
Yeah.
Let it go.
Mate, if
Go
you were
after
a
the
big,
banks.
if you were a big bank, you could negotiate out of that.
Oh, I'd be giving junk loans back for sure.
Yeah. So look, the story here, there's a lot more to it. To give another plug to Equity Mate Thought Starters,
Yeah.
I'm going to put the whole article that broke this whole story in the email, so you can read all about it tomorrow morning when you're listening to this podcast. And just to give you one little teaser to add to this whole story, there's a bizarre twist in here. And the Church of Scientology is actually complicit with JP Morgan Chase in this fraudulent mortgage payment scheme.
Really?
So that's a little teaser for all of you out there.
I'm not surprised. Dodgy church.
Yeah, I know. Dodgy bank, dodgy church. Yeah.
Interesting. Well, nice one, Ren. That was interesting. And I just hate hearing things like that as well. It makes me pretty angry, to be honest. Like,
It gives all this credence to when people say, you know, markets are corrupt or there's a two-tier justice system in America.
Yeah.
Like, I fundamentally disagree that markets are corrupt. I think it's pretty obvious that American justice system has some work to do.
Yes.
But, you know, these are the things that just make
joke.
people lose faith in the system.
Yeah, definitely.
Yeah.
Great. Well, my thing that I learnt this week, and this may be old news, but I just stumbled across it doing some reading, and I'm sure as a well-read man that you are, Ren, that you know about this, but it's China's Silk Road, and it's called the One Belt, One Road development.
Yeah.
And I just found this really interesting. As I said, I wasn't aware that this was going on. So just in brief, essentially the One Belt, One Road is a massive worldwide infrastructure project that the Chinese are essentially funding and pushing. It involves, I think, up to about 65 countries in total. And, you know, the total population reach of all these countries is about 4 billion, because what they're doing is building a whole heap of roads, railways, ports, and then also maritime routes through these old trade corridors that used to be in existence in areas through China and Russia and up through the Middle East into Europe.
Yeah.
So what I found interesting about this, and I'm sort of thinking in investing, you know, back to Australia, how can it affect what's going on here? And obviously there is huge demand, and will continue to be huge demand for obviously our iron ore and natural resources to get steel and whatnot to actually build these this project. So already to date, they have $1.3 trillion worth of projects initiated, so in development as we speak, in Africa as well, and yeah, as I said, major central parts of Central Asia. So there's two things is, you know, Beijing has their finger in a lot of pies now across the world, and if you're to look down the future and say 30 or 40 years when this will be well into existence and fully up and running, you know, they're going to have control of a lot of, you know, infrastructure around the world. But I just thought it was a fascinating project that's underway with trillions and trillions of dollars going to be spent. And it also presents a great opportunity for Australia, not only in terms of, you know, currently what we can give them in terms of natural resources and all that to support the infrastructure, but also once it's complete, it's also going to open up better trade opportunities for us as well, up through Asia and into Europe. So I'm not sure if you were aware of that, Ren, but I found it fascinating. Huge dollars.
It is fascinating, and it's a fascinating look at China's expanding sort of soft economic power.
Yeah.
So you look at some of the countries that it's partnering with, and you know how it's trying to get up into Europe and broaden that trade relationship. It definitely represents a shift in the sort of economic center of the world, I guess.
Definitely.
And you could sort of, you know, after World War II, the US instituted the Marshall Plan, which just invested billions of dollars throughout Europe and
Yep.
rebuilt the world after World War II, essentially, and it made America the economic focus of the world, essentially, after World War II. You could see this investment as something similar for China. They're trying to, broaden their trade relationships basically with the whole world through these investments, and essentially with the aim of making them the economic focus of the 21st century.
Yeah.
Because you'll notice if you look at a map of the One Road, or it's One Belt, One Road.
One Belt, One, yeah.
Yeah, you'll see that basically it touches everywhere in the world except the Americas, except North and South America.
Yeah, definitely.
And don't think that's an accident. Like,
no.
It's not just they're doing an overland route into Europe. It's a bunch of ports everywhere through the South China Sea, through Asia, into Africa.
Yeah.
But nothing in the Americas.
See you later, America.
Yeah. So...
No, I agree, and that's what I was saying. In 30 or 40 years, when this is in full operation, like, these guys are going to... Well, they're going to own so much of it, because they're funding all this as well, so...
Yeah.
It's just phenomenal. All right. Well, those are two good things that we've learnt this week. They're now a little bit smarter than we were before. Well, not necessarily smarter, but, we've learnt the
I gotta say, I miss the days when we were just talking about Netflix recommendations on this.
True. I've been too busy reading about One Belt, One Road.
Yeah. I think that is probably more valuable for our listeners. So I think we're getting better at this.
I do have a good Netflix recommendation, but I'll save it for next episode.
Oh no! Come on,
No.
Save it for the end of this episode, so
Right.
people have to listen for the whole episode.
I'm sure they're hanging out tonight. All right, moving on. I'm going to call this little segment "Pardon the Jargon," and as we said before, Ren, that this is probably a segment that we will continuously do down the track, because there's so much jargon out there that is worth explaining, because the jargon is worthwhile and it's worth knowing and understanding. But as you mentioned, Ren, it's often these sort of words and acronyms and phrases that deter people and throw them off. So, pardon the jargon. We're going to look at 5 acronyms or ways of valuing companies, ratios, and explain them.
5 pieces of jargon.
5 pieces of jargon.
Yeah.
So, as a bit of a caveat, each of these ratios, jargon, whatever we want to call them, definitely needs to be considered in the context of the company, because there's no golden number that can be applied to each of these, because all companies operate differently. One company may need huge levels of debt to operate, and while the same level of debt may destroy another company. So that will relate to, for example, the debt to equity ratio that we'll discuss later. But the main lesson that we want you guys to get from this segment is just to get an understanding of the fundamentals behind a lot of these metrics that we're going to talk about, so that you can start to apply them in your own thinking. And these metrics, as Ren mentioned, are widely used across the industry on balance sheets, annual reports, that sort of stuff, by investors and, well, everyone in the industry essentially. So we're going to put emphasis on, as we said, 5. So let's get stuck in.
Yeah. Do you want to kick us off?
Sure. So the first one is called EBIT, and it's something that you'll find on a balance sheet when they're reporting their income. So it's an acronym, EBIT. DA is the bigger version. EBITDA, is that how you say it? EBITDA?
Yeah, EBITDA.
EBITDA. So you'll see this in capital letters, EBITDA, and essentially it stands for earnings before interest, taxes, depreciation, and amortization. And it's just a long-winded way of saying this is what we have earned as a whole before taking out any sort of expenses, taxes, as it says in the acronym, interest, etc. And it gives us an idea of the financial performance of the company. So a lot of investors will look at this to understand the trajectory of a company before expenses are taken out.
So maybe the best way to conceptualize it is to understand what isn't taken out. So if you think about your normal company that, makes something and sells it, the this EBITDA is, the amount of revenue they make from selling their good, and then it includes, the cost of staff, the cost of their buildings, the cost of the raw material, the cost of manufacturing, but then it doesn't include these additional costs of interest payments on debt, of taxes, and then of depreciating and amortizing their assets.
Yeah. And just briefly, amortization is a routine decrease in the value of an intangible asset, or essentially it means paying off debt over time through regular payments. So not worth going into, but that's just what it stands for. So yeah, it's essentially just shows if the fundamental of the business selling goods, this is what it's making. So you'll have this on the balance sheet, and then it's broken down to EBIT, EBIT, which is earnings before interest and taxes. So if you're looking at a balance sheet, you'll see EBITDA first, then they'll take off depreciation and amortization expenses. Then you'll come to EBIT, which is net income, interest, taxes, as I said, and it's a measure of a firm's profit. And then once you then take out interest and taxes, you will essentially land at net profit.
And when you say take out, you mean include in what they're deducting.
That's right.
Yeah.
And so you'll then hit net profit. So not much to really, I just wanted to give a broad definition of what these are and to actually say what they mean. You'll see it on the profitability part of your balance sheet, but it's just a good indication essentially of a firm's profitability. In a nutshell, all three metrics try to measure a firm's profitability. Net profit is like actually how much profit they made in that year, and then some investors like EBIT and EBITDA because they think taking out those lines of expenses gives a more accurate understanding of how the company's actually going. Yeah.
Because like taxes are something that's imposed by the government, they actually aren't reflective of the underlying business performance.
Yes.
Same as like interest payments on debt or the depreciation of assets. That doesn't actually reflect the underlying performance of the business itself. They're just sort of statutory.
Got to do.
And But just be careful of that because depending on what metric you're looking at, you're going to see different numbers for profitability.
Yes. Yeah. And this is where the company likes to sort of fluff their feathers a bit.
Yeah.
With these ones. All right, moving on, Ren, you've got one for us.
Yeah, so following on from that, so that's different ways of looking at a company's total profitability. One that you'll see all the time is EPS. Now that stands for earnings per share. And so what that is you take the company's net profit, and then if a company pays preferred dividends, you have to take that out. But don't worry about that for the just general purposes.
Yeah.
Earnings per share, you take a company's net profit and you divide it by the total number of shares. Now this is a really
straightforward.
Yeah, it is. And it's a really useful metric when you're trying to compare the price that you pay for a share to how many earnings that you as the business owner of that share of the company earned.
So are you saying that, are we talking a dollar figure here or a percentage?
We're talking a dollar figure here.
Okay.
So let's, by way of an example, let's say company A has 100 shares and made a net profit of $1,000 this year. So you take the $1,000 net profit figure and you divide it by 100 shares. That means each share is worth $10 of those total earnings. Okay. So and then you can look at the share price and say, as an investor, what am I willing to pay for that $10 worth of earnings? So, if the share price is $1 and the company has earnings per share of $10,
bargain.
Then that's great. That's unbelievable.
I'll take that any day.
Yeah. But, if the share price is $150 for $10 a share, then maybe you start to think, I might really like the company, but it's got to grow its earnings a lot to be good value for me. So it's a good metric to compare to the share price that you're paying.
Okay, so say if, for example, we refer to your company A and your EPS comes out at $10, but the stock price is $1. does that mean it's a certain buy? Do you know what I mean?
No, because you could be paying. There's might be a reason that it's only $1. So it might have a huge amount of debt, and even though it has earnings of $10 a share, that won't cover its debt repayments or just the interest payments on debt, and so you can see that the company's spiraling into bankruptcy.
So this isn't a measure of the value of the company if you divide shares by the profit. No,
there's no magic bullet. There's no this one metric gives a perfectly accurate representation of value. If that was the case, then markets would be perfectly valued, and
we wouldn't be doing anything.
Yeah, well, it would be a lot shorter podcast. It would be episode 1. Here's this metric. Just whip out the calculator and do that.
But yeah, this is a very talked about performance metric.
Yeah, big time.
Yeah, that's a good one. Speaking of shares and returns on shares, that flows in nicely to another ratio known as ROE. And do you want to give an explanation of what that means?
So return on equity, ROE. It's another really common one that you see.
Yeah.
And essentially it is a measure of how productive a business has been in that year. So what you do is you calculate, they call it shareholder equity, but all it is the company's assets minus the company's liabilities. So whatever that is left over is the shareholder equity. And then you see from that equity base how much net profit it can make. So to give you an example, if our hypothetical company A has $200 in assets and $100 in liabilities, then its shareholder equity is $100 because it's 200 minus 100.
Yep.
And let's say it makes $150 off that $100 in shareholder equity, then its return on equity is 150%. Because from its base of $100 of equity that it could use to make a profit, it made 150%. Yeah.
So earnings per share and then return on equity. Can these be looked at together? Because to the average Joe, they seem pretty similar.
Yeah, they can be. So a good way of thinking about long-term investing and thinking about trying to find companies that will compound and grow into the future is to look at a company's historic return on equity to see consistent earnings per share growth as well.
Yes.
If you're seeing those two indicators consistently growing and heading in the right direction, that's a really good indication that you've come across a company that will continue to grow into the future.
Yes.
And if you just take one of those metrics, so let's just say earnings per share is growing really well, but you're not looking at return on equity, there could be other reasons why the earnings per share is growing. It could be taking out a lot of debt, it could be acquiring other companies. But if you look at EPS and return on equity, you can see that it's consistently growing and it's being productive with the assets that it has.
Yeah.
So
just very briefly, can you tell us where we can find these two measures?
So you can find them on most finance websites, Yahoo Finance, Google Finance. All annual reports will have earnings per share. I'm pretty sure they'll all have return on equity. Most of them will have return on equity as well.
Yeah, and as you mentioned, if they don't, then it's very easy to get a calculator out and do it yourself. And
it's probably worth saying the sort of a good company or like an average to good company gets 10 to 15% return on equity a year.
Yes.
Anything above 20% is great.
Killing it.
Yeah.
Yeah. My sort of figure is roughly 15%. I like to see that in a company. All right. So we've talked about earnings per share. We've talked about debt to equity. Talked about EBIT. So the next one that is worth mentioning is known as the debt to equity ratio. This is something that is another common measure, and this one's important because it gives us an understanding of the level of debt to the level of shareholder equity or the level of investment run by a company. Now, this is one that really needs, they all are, but this one needs to be taken with a grain of salt because there is, as we said, no magic number. because most companies do need to borrow money at some point in time to, build and fund operations, continue to expand and grow. And so the debt to equity ratio is not necessarily, it doesn't highlight whether or not the debt is good or bad. So that's the main thing to consider with this.
Yeah.
It shows the relationship and the balance between debt to equity, but you need to go and do some further investigation as to if this debt is continuing to improve and grow the company, or if it's due to poor management, essentially. So
yeah, but even good debt one day can be bad debt another day. So
definitely,
it's not even as simple as saying, well, this is good debt, because when you get it, it could finance a great new idea, but then interest rates could shoot up and it could all of a sudden be bad debt.
Or what you thought was a good idea turns to
yeah.
So
yeah, Woolies would have taken a lot of debt to build Masters, which was a great idea at the time.
So fundamentally, the debt to equity ratio is a measure of the company's borrowings expressed as a percentage of shareholder equity, as I mentioned. So it divides total liabilities of the company by shareholders' equity. Now, a higher debt to equity ratio means essentially that more bank loans have been used to finance the company's endeavors rather than shareholders' equity. So essentially they have said, we need to raise money, we need money to do whatever we need to, this project that could be awesome. So we have two options. One is to go to the bank and ask for money, or two is to get the shareholders to invest more and fund that. So this is what that ratio tells us, how much of each and what is the percentage. So for example, if a company has a debt to equity ratio of say 27%, it means that 27% of the company has been financed by debt, and the remaining 73% is financed by shareholders. So when investors are looking to understand a company's debt, they'll look at this measure. But as I said, all companies are different. As a side note, banks and financial institutions, you won't be able to find a debt to equity ratio online or on their balance sheets, because they're actually the ones doing the lending. So it's subtracted or not included when looking at those sort of businesses. So if you're looking at Commonwealth, for example, you won't find a debt to equity ratio because it's not relevant to them.
Yeah, well, it would be tough to calculate as well, because when we deposit money with those banks, technically they just owe us that money and then they loan it out. So technically that would be in debt to their deposit holders, and then anyway, it would be confusing. Yeah.
So it is possible to have a debt to equity ratio above 100%, which would be, it is possible. And as I mentioned, just be aware that a high debt to equity ratio doesn't necessarily mean it's trouble. So I'm thinking of a company, say, for example, Transurban, which we have mentioned in the podcast before, which needs huge amount of borrowings and debt to fund their infrastructure developments of highways and roads. But that doesn't necessarily mean that having billions and billions of dollars on their balance sheet is a bad thing for their company. So that's just an example.
Yeah.
All right, cool. So that's number 4, debt to equity. And then one that I always sort of heard when I started getting into stocks is the PE ratio. Everyone's always talking about PE. So Ren, do you want to give us a rundown of what is the PE ratio?
Yeah, so PE, price to earnings ratio. So this is a measure of the share price relative to a company's earnings, and it's expressed as a sort of multiple. So if we take our hypothetical company A and its share price is $10 and the company's earning $1 per share, then the price to earnings ratio is 10, because the earnings are 10 times the price.
Yeah.
So
So this ties back in with your earnings per share that we discussed earlier.
Yeah. The reason we use this metric, it's a really quick way of seeing the value of a company, because if a company has like 58 times price to earnings ratio, like A2 Milk does at the moment, you can say it's quite expensive, because I'm essentially paying 58 years worth of earnings. But if a company has a price to earnings ratio of sort of 5, then you can say, all right, well, it's quite cheap relative to the amount of money it's making at the time. Yeah.
So is it good to have a high EPS? Is it good to have price to earnings, PE, or do we want to find companies that have a low PE, or what should we be looking for?
Look, that's kind of like a how long is a piece of string question.
Yeah.
In general, it's always better to have a lower price to earnings because it's in theory cheaper. But the issue is, companies that have great growth prospects, generally that will be priced in, and so you'll have to pay a higher price to earnings. You'll have to pay a higher PE to get in, and companies with low PEs, there's reasons for that. They might be in a lot of debt. They might not have good prospects going forward. There might be a competitor that is, strongly nipping at their heels. So just looking at PE alone doesn't really give the whole story.
No.
If you find a company with great growth prospects and sort of the market hasn't realized that yet and it has a low PE, that's sort of the goal, I guess.
PE is one of those ones that it's really important to look at in context. It's good to look at in context with companies in the same industry or sector, because it helps to give you an understanding of, okay, so if the average PE for, say, companies that provide medical products for hospitals, for example, say there's 6 companies and they all have an average PE of 15 and one has a PE of 85, that helps to give that number some context. But if you looked at it solely on its own, it's hard to get an understanding of what that actually means.
So they're the 5 that we wanted to talk about today. Now, I know it was a lot of information. We'll chuck a quick blog post up that it re-explains those 5. But just to go over them, it was EBITDA and net profit. So different ways of explaining how profitable a company is.
Yeah.
Number 2 was earnings per share. So that's taking how profitable a company was and dividing it by the amount of shares there are in the market.
Yeah.
Third one was return on equity, ROE, and that's about how productive a company is with, the assets that it has that year.
Yeah.
Number 4 is debt to equity ratio. That's a good measure of how much debt the company has. And obviously, the more debt, the more worried you should be.
And then, relatively, yes.
Yeah. So that's a little bit too general. Debt is sometimes necessary and is sometimes important.
It's how they manage the debt.
Yeah, exactly. And then last but not least, price to earnings ratio. That's just a good, quick snapshot of how much you have to pay for a year's earnings of that company. Yeah. So they're all terms that you'll see in financial news articles or annual reports, and they're just ones that are good to know to start doing your own research on different companies.
And all very easy to find. As you said, Ren, you can get them on annual reports or very easily through Yahoo Finance, Google Finance, or whatever it may be. So start getting your head around them and having a play with how they work for the company, and then also in the broader context against other companies. And it's a good way to get a snapshot of how the company's going.
Yeah.
Awesome. So moving on, the final segment is one that we haven't done for a while, Stock of the Week. Now...
Yeah, it's back.
Sorry, pardon me. It's back. And in a slightly different format. I think that we took some time to think about this segment, and we were not so much concerned, but we didn't want this segment to in any way reflect advice on what stocks to buy, and we didn't want anyone going out there and putting all their money in what we have suggested, because that's not why we're here. We're not here to tell anyone what to buy. So the way that we're going to do this segment now is stocks to watch, and Ren and I have obviously a list of stocks that are on our watch list, and we play around with them week on week and like trying to find different ones here and there. And so we thought, rather than specifically discuss one stock, we will have an open discussion briefly in not too much detail about a number of stocks and where we sit and what we think of them, and then we'll choose one of them to add to our hypothetical portfolio that is still running in the background, just to show that consistency is key, essentially, and that's the message we've been trying to flog. So
Yeah, like we're not here trying to pick stocks. We're here trying to show that consistent investment in the market, even by two idiots such as ourselves, will pay off over time.
We hope.
Yeah, well, I mean, and like if you look at our hypothetical portfolio at the moment, there's only one stock that has done really well. The rest are sort of, some have gone down, some have flat,
Yeah.
but overall the portfolio is up 12%.
Hey,
So
great.
you don't need to hit a winner every time. You
No.
just need to get yourself in the market, give yourself time, let those companies develop and grow, and even if you're a couple of idiots trying to do a podcast, you still can make money. You don't have to be a professional sitting in front of a 3-screen trading desk for 8 hours a day.
Well, as you said, buy and hold, baby.
Yeah.
Set and forget.
Yeah, that's it. Yeah.
All right. Well, not to flog a dead horse, I'll start. And I think these have always been on my watch list for various reasons, but have certainly shot to the top just because they've had some phenomenal growth over the last, well, for one of them since the start of the year, and for the other definitely over the last month. I think it's gone up 30-odd%. So the first one is Bellamy's Wren, and we've discussed this,
Yeah.
I think, on and on and on for, as I said, various reasons. But as I said, it's gone up, I think, about 30% in the last month. And that's because recently, I think it was late last week, they gave a guidance update, which means that they've come to the market to say that what we originally told you guys we would be earning has now increased, and in keeping with regulation, we need to tell the market about it. And so they said that what they originally thought would be 5 to 15% revenue growth, or EBIT growth, as they said, I think they've now increased to 20 or 25%. So the price shot up. So I mean, it's now $10 or 10 plus, I'm pretty sure, coming from a $3 base only a matter of 4 or 5 months ago. And for the listeners that have stuck with us since episode 1, they would know that I bought this stock at $5. It went to 15. It fell through the floor to $3. I then sold it at about $5. Made a flat. I didn't make any money from it. So the lesson to learn is that it fell through the floor at $3, and you kept the stock, didn't you, Ren? You were also in it. You've kept the stock, so you're now back up in the black.
Yeah.
I sold, kicking myself.
Not to rub salt in your wounds.
Yeah, please don't.
But I think just for our listeners out there, it is a classic example of markets react too strongly.
Yes.
But in both ways.
Definitely.
So Bellamy's was selling into China, through this sort of grey market, and the price skyrocketed up because the people heard China. And then the Chinese government started to regulate this grey market, and that restricted Bellamy's access to Chinese market, and people just flat out panicked, and it dropped from $15 to $3. But in both cases, it was an overreaction.
I know.
Like, the Chinese demand didn't change.
No.
And over time, these companies will be able to work ways to satisfy that demand.
Yeah. This whole thing for me has actually been a really good lesson, and something that I'll definitely reflect on going into the future. And everything from withdrawing the emotion of seeing your stocks go from $15 to $3, and actually taking a step back or not even looking at the stocks really. That was my first mistake. And I should have just stayed in the market, because look at them now, killing it. However, I'm not saying that this is one that I will buy back into at the moment. I'm not sure. It's trading at a very high, as we mentioned, price to earnings ratio. And
look, there's still risk. Like, the Chinese government may crack down on Bellamy's again and may restrict them. Sometimes those decisions can be quite arbitrary in terms of what can be sold into China and what can't be.
Yeah.
But look, at the end of the day, even if they can't keep selling into China, they're an in-demand brand. There are other markets.
I think 75 or 80% of their business is domestic anyway. So
yeah. So obviously China would be a blow and the share price would suffer. But I'm just gonna buy it and just never look at it, and then when I retire, hopefully it's gone up.
Well, I mean, I'm kicking myself. Lesson learned. So another one that you've also harped on about for a while now, and for very good reason at the moment, Ren, is has appeared on my watch list again because I've been watching it go up and up and up. Is A2 Milk, and you've absolutely smashed it with this one. Made a nice little profit.
Yeah. So it's my very first 10 bagger, which
Okay.
is when it's gone up 10 times.
Yeah, nice. More than now.
Yeah.
But this is a good one to highlight price to earnings ratio because I did a bit of evaluation on it, and this is something I might talk about next episode in detail, but my valuation for this one came out at roughly $2, $2.20. Now, as I said, this is very open to debate, and I'm not sure. I think that's a little undervalued, to be honest, but it's trading at $7, I think, or $6.98 or something, and this stock has just been running like wildfire, and I have a feeling that it's one of those stocks that will be the 2017 darling of the market. Everyone's jumping on board at the moment, and it's been, I mean, for good reason. It keeps coming out with higher and higher profits, and it's expanding into Asian markets, and it's in Europe, and it's in the States. That, I mean, there's some issues around how they're going to get brand control over there, but it's on my watch list just because I've looked at it so many times and seen it go up. It would be a momentum buy for me because it's definitely, I think, overvalued and might have a correction. Who knows?
I mean, it is definitely, it's crazily valued.
Yeah.
So we were talking about price to earnings ratio before. It's trading at something like 58 times earnings.
Which is huge.
Yeah, and the industry standard is sort of 15 to 20.
Yeah.
So that gives you an idea of how much hope investors have about the China story, really. And, people are investing with the expectation that A2 Milk sells very well in China and some other export markets. And that's the only real reason that you could justify paying the current price for A2 Milk.
Well, that's the thing. That's one of the risks that you run when you buy into a stock like this that's running so fast and at such high price to earnings ratios that the minute that they don't meet expectations, market expectations, and it could be a miss of expectations of, say, I don't know, $500,000, like nothing, then it's probably going to be one of those cases where it gets punished in terms of stock price. So buyer beware for this one.
Yeah, definitely.
All right. Do you have any to throw out there?
Yeah. So there's a couple of stocks that I've been looking at this week. One that fascinates me is called Altium. I didn't actually write down its stock ticker, but I'm sure it would be easy to Google.
Yeah.
But what they do, so they create software, design software for printed circuit boards. Now, printed circuit boards are the backbone of electronics, computers, all the like. And I was looking at them because it's a good way to benefit off the Internet of Things.
Okay.
So I'm sure people have heard about, smart homes that are coming in, and they're going to be the next big thing. Your fridge will be connected to the internet, and your washing machine will talk to you, and all that.
Yeah.
It's sort of, Google Home and Amazon Alexa. Apple might have one as well. But they're going to be the control pieces for all of your Internet of Things connected home devices. So, you'll tell Amazon Alexa, turn the lights on, and your Internet of Things connected lights will turn on. The backbone of all of that infrastructure is these printed circuit boards. And Altium are a market leader in the software to design these circuit boards. So they fascinate me for that reason. And they've been a strong growing company recently. So from some of the metrics that we talked about before, their price to earnings ratio is 38. So it's pretty expensive.
Okay.
Just looking at that, their debt to equity, they actually have no debt, which is a great sign for a business.
It is.
Their return on equity last year was 20%, so that's good. And their earnings per share is 56 cents.
What are they trading at the moment?
It's about $11 something.
Okay.
So with the price to earnings, this is where it gets confusing, and this is why you can't just look at their metrics. So their price to earnings is officially 20.
Yeah.
But their price to earnings without non-recurring items is 38. So
I don't think I've ever seen that.
yeah, I was looking at a website and it had it listed. So essentially that means that, there were one-off items in financial year 2017 that improved their price to earnings, so bumped up their earnings a lot. But those, whatever that was, won't be reoccurring going forward, and so that bumps out the price to earnings ratio. So that's something you've got to look for.
What are some of the risks for this company? Do they have any major competitors? Do you know?
Yeah, look, there are a bunch of competitors out there. One of the risks that I was thinking about also was that how much of this will be automated? Like,
Yeah.
at what point will humans not need to design these circuit boards?
Yeah.
But look, that's probably further down the line. The biggest risk at the moment is just they're pretty expensive for their current earnings, but look, they have great growth prospects. They have an aim so they just cracked $100 million in revenue,
Okay.
and they have an aim to crack $200 million within the next 5 years, I think it was, or 3 years.
5 years.
Yeah, they're pretty ambitious, as all Silicon Valley companies should be, I guess. But yeah, look, that was one that really interests me.
So is it an Australian stock?
Yeah, it's an Australian stock, but they've moved to Silicon Valley.
Play with the big dogs.
Yeah, but they sell worldwide.
Yeah, right.
Yeah, so that was one that interests me.
Nice.
It's on my watch list. If it drops in price a little bit, it might be something that I look to buy, but at this stage, it's probably a little bit too expensive.
Yeah, quick calculation based off earnings per share, etc. I've come up with $8.96.
Okay,
Yeah.
that was quick.
Yeah, very quick.
Yeah, there you go.
Mate, I'm speedy fingers on the calculator over here.
Yeah.
So speaking of, Internet of Things, I was sitting on the balcony yesterday, and opposite our place is a bunch of apartments, and I heard a lady at the top of the apartment yell from her balcony, "Google, turn it off!" And then the music stopped. I was like, "There you go, it's happening. It's around."
Yeah. Shit. What we got to do though is we've got to decide on one to put in the portfolio.
Well, based on what we discussed, I don't think Bellamy's or A2 Milk would be a good idea at the moment.
Okay.
So through a process of elimination, it leaves Altium.
Yeah, Altium, I guess. Yeah, it's a little bit expensive. We just talked about, but
not as.
Oh well.
I'm more confident with it than Bellamy's A2 Milk. I'm also
Fair
a lot
enough.
more interested in it.
Yeah, that's the thing.
Yeah.
It is interesting.
Yeah.
All right, well, we'll chuck that one in, and hopefully the CEO's prediction of $200 million comes true.
Pays off.
Yeah.
So yeah, we're going through a bit of a website pivot at the moment, and I don't think that our stocks of the week portfolio is visible online, but I'll make sure that we get that up in the next few days for everyone to refer back to. So yeah, that's a promise to you guys.
There you go, a Bryce Lesky promise.
They're rare these days.
First one of the podcast.
Okay, so in summation, we've discussed obviously what we learnt this week, but then pardon the jargon, we went through 5 investing terms that are relevant and important when looking at a company, and they're very easy to find online and through company reports, annual reports, that sort of stuff. We looked at EBIT, earnings per share, return on equity, debt to equity ratio, and price per earnings, and then wrapped up with the stocks on our watch. So I hope you guys learnt some stuff through this episode. And as we said at the start, we're now on YouTube, so check us out.
Yeah, we're YouTube official, guys.
We are. We're on. We're everywhere now. You can't escape us.
Yeah.
And
Netflix miniseries coming next.
we're on. And Ren is going to be flicking out the Equity Mates Thought Starters on Sunday or Monday, Ren? Sorry.
Monday.
Monday morning.
Yeah.
Make sure at 5 a.m.
Yeah,
That's
yeah.
not a promise.
Make sure you sign up because we've got some cracking articles coming out this week, including the Church of Scientology twist on the JP Morgan Chase story that I told this morning.
Game changer.
I mean,
I'm looking
earlier,
forward to this one. So, yeah, definitely sign up because this is going to be a very valuable tool for you guys, I think, and something that we're going to put a lot of time and energy in because we think it's going to be of great benefit to you guys. So sign up through our website or through our Facebook page, and don't miss it. Yeah, every Monday, something that will keep you going through the week. So
Yeah.
Great to have you for episode 20. Enjoy your weekends. Well, by the time you're probably listening to this, you've already had it, but you enjoy your weekend, Ren.
Thanks, mate. You too.
And we'll talk to you next episode.
Can't wait. Equity out.
Equity Mates and the people appearing in this program may have positions in the companies mentioned. This is general advice only. Please speak to a financial professional to understand how it may pertain to your individual situation.